Welcome to the Deep Dive. Today, we're cutting through the noise on Viking Holdings, ticker VIK, after their Q3 2025 earnings release.
Which dropped pre-market on November 19th.
Exactly. And the market just, whoa! It cheered. The stock shot up on some really heavy volume. So our mission today is to break down what exactly happened.
Yeah, and that reaction wasn't just noise. I think it signals a whole new narrative for Viking.
Right.
We're moving past that, post-IPO story.
Right.
And we're getting into a story of sustained, highly profitable, and I'd say de-risked compounding growth. We're going to distill what they reported from the record operational numbers to the pretty aggressive balance sheet moves that really solidified this shift.
Okay, so let's start with that snapshot. The headline figures. To me, they felt like a really quality performance, but maybe not a massive blowout.
I agree with that.
Adjusted EPS came in at $1.20, which just barely beat the $1.19 consensus. Revenue was basically in line, almost $2 billion.
Yeah, $1,999.6 million, right on that $2 billion expectation. But you're right, the real story, the insight, it's all in the details. It's all about efficiency.
So let's get into that.
Absolutely. The top line was, more or less what people expected, but the operational quality was just staggering. Viking reported a company record net yield of $617.
And for anyone not totally familiar with cruise metrics, that's basically their revenue per bed, right? It's the key profitability metric.
It's the key one. And that 617, that represents a really strong 7.1% increase year over year.
7% pricing leverage in just 1 year. At their scale, that's phenomenal.
And that yield, you combine that with the demand they're seeing across their, 103 vessel fleet?
A milestone they just passed, yeah.
It drove their adjusted EBITDA to a record $703.5 million. That's a 26.9% year-over-year growth.
Which gives them a margin of what, about 35%?
A very, very healthy 35% EBITDA margin. So, they're not just selling more cruises, they're selling them at much higher prices, and that profit is just flowing straight down to the bottom line.
The operational performance is clearly firing on all cylinders, but what I think really got the more sophisticated investors excited was the work they did on the capital structure.
Yes.
This is where Viking kind of went from being just a successful cruise company to signaling some real financial maturity.
Exactly. The focus was on deleveraging. And the speed at which they did it was, pretty incredible. Net leverage improved to 1.6 times.
Down from 2.1 times just the quarter before.
Just 1 quarter prior.
Yeah.
That kind of rapid reduction, it just shows incredible financial discipline and, frankly, amazing cash flow generation.
Let's just pause on that number, going from 2.1 down to 1.6, because that really fundamentally changes the company's risk profile. What does dropping leverage that fast actually tell us?
Well, it's less about just simple debt reduction and more about moving into a position of what I'd call capital optionality.
Okay.
When you're sitting on $3 billion in cash and you have that massive $4.3 billion in deferred revenue, which is basically just guaranteed future sales.
Right.
And then you pull your leverage ratio all the way down to 1.6, you're telling the market you've moved from capital preservation to being ready for capital deployment.
And they didn't waste any time using that newfound strength.
Not at all. In September, Moody's saw this stability and upgraded them to B2, a really significant boost. And management immediately capitalized on it. They went out and issued $1.7 billion in senior unsecured notes due in 2033 at 5.875%.
So why is that debt issuance so important when they already have so much cash?
It's just smart, proactive liability management. They used the money to retire old notes that were due in 2027 and pay down some leases. So what they're doing is locking in relatively cheap capital for a really long time.
So no refinancing anxiety for years.
Exactly. It insulates them from future rate hikes. It extends their maturity runway. And on top of that, they upsize their revolving credit facility to $1 billion through 2030. That flexibility is crucial for funding fleet expansion without being dependent on the markets. It's the textbook definition of fortifying your balance sheet.
That said, even the best companies are facing cost headwinds. They did mention some inflation on the call. Vessel OPEX, excluding fuel, was up 9.6% year over year.
It was.
So should we be worried about that, or do we just accept management's line that it's just, timing of repairs and itinerary mix?
That is a necessary challenge.
Yeah.
You always have to scrutinize cost growth. Management did say it was higher port charges because of the itinerary mix, more expensive destinations, and the timing of maintenance. And while that's true, in Viking's case, the numbers show the growth engine is just moving fast enough to outrun inflation. And then some. Well, because their capacity grew by 11%, that's in passenger cruise days. And you combine that with the record 7.1% yield increase, and it just more than offsets that 9.6% cost growth.
So that's classic operating leverage.
Classic operating leverage. And crucially, their SG&A, their overhead, stayed flat as a percentage of gross margin. It shows disciplined investment. So yeah, costs are rising, but revenue per customer is rising even faster, and that leads to sustainable margin expansion.
And that efficiency is only really possible because of their forward visibility, which is, I think, where the story gets really interesting.
It's the core of the bull case.
In the travel space, Viking is just such an anomaly. Their reservation desks are basically closing the books for years in advance.
Unquestionably. I mean, the CEO, Torstein Hagen, he made it clear. They aren't hoping for future demand. They have already locked it in. For the 2025 season, and remember, they're increasing capacity by 12% that year.
Right.
96% of that capacity is already sold.
96% sold for next year. The cruises booked out before Thanksgiving. That kind of certainty just gives them a massive advantage.
It is the CFO's dream. And now look out to 2026. Capacity is going up another 9%, and they were already 70% sold.
70%.
That forward book translates to $5.6 billion in advance bookings for 2025 and $4.9 billion for 2026. I mean, this isn't theory. This is guaranteed revenue already sitting on the balance sheet.
And because that demand is so sticky, it lets them lock in some pretty significant price hikes. What did they officially confirm for the coming years?
Well, that's it. That strong load factor flows directly into higher prices. They've locked in price increases of 7.5% for 2025 and 5.5% for 2026.
Wow.
So when management says mid-single-digit yield growth is already baked into the book, they mean it's contractually confirmed for the next 2 years. That visibility just gives you phenomenal confidence.
Which brings us right to their strategic moat. Management is constantly separating Viking from the mass market lines. They're positioning themselves for the traveler who wants cultural enrichment. The person who is, as they put it, tired of being on ships with children, who is this incredibly resilient customer.
It's the older, affluent North American and European traveler. This group, they have more discretionary wealth, and for them, travel is an essential lifestyle choice. They prioritize destinations and, educational experiences over things like water slides and casinos.
So they're more insulated from economic bumps?
Much more resilient to things like inflation or minor slowdowns.
Yeah. And their moat is also physical. It's about scarcity, right? Their control over key river docking locations.
That might be their most overlooked structural advantage, especially in their river business, which is highly profitable. Viking has priority access to 113 coveted docking spots around the world.
They gave some examples, right?
Yeah, you dock right near the Eiffel Tower in Paris, or right next to the Karnak Temple in Luxor. These are spots competitors just cannot get because of capacity limits and Viking's decades-long relationships. It's a physical moat that's almost impossible to breach.
They also talked a lot about innovation, specifically using AI and data in their marketing and revenue management. What does AI optimization actually mean for them in practice? Are they just dynamically jacking up prices every day?
That's precisely the claim, and I think it's more than just generic management speak. They're using predictive analytics machine learning to analyze booking patterns and demographic sensitivity. This lets them dynamically adjust pricing up as inventory gets scarce instead of just using fixed price lists.
So they're squeezing out every last dollar.
They confirmed this is how they're getting that sustained yield expansion on top of the capacity growth. It really suggests they're running a more sophisticated tech-enabled system than their peers are.
So you have a resilient customer, physically protected assets, and a data advantage. It's a powerful combination. Let's see how the market processed all this good news. The stock closed up over 5%.
On almost double the normal volume. It clearly signals new buyers accepted this whole narrative. And if you zoom out, the performance is pretty striking. VIK is up 38% over the last year. The travel ETF, PEJ, is up, 9.6%?
That's a huge outperformance.
It's investors recognizing that Viking is just playing in a different, higher quality league.
And the analyst community, which can be pretty skeptical, I saw a mixed but mostly positive reaction. What was the read from the street?
Well, Goldman Sachs, they were already bullish. They raised their price target to $66, Wells Fargo raised theirs to 62, but kept an equal weight rating, basically saying the results were great, but maybe some of it's already priced in.
And what about the bears?
Even the more cautious voices, like Mizuho, they have an underperform rating, they had to bump their target to 59 and admit that the forward pricing strength was a welcome update. So even the bears have to respect the visibility.
Yeah, management seemed totally unbothered by questions about competition or capacity shifts in places like the Caribbean.
Their confidence just comes from their niche. They know who their customer is. They know that the Caribbean is only, 4% of their ocean capacity, so overcapacity there just doesn't affect them.
Right.
They just reiterated their philosophy, designed for cost and efficiency rather than for bells and whistles.
Sure.
The gap between a mass market entertainment ship and a Viking destination-focused ship is just vast, and management is betting that chasm only gets wider.
Okay, so we've covered the records, the fortified balance sheet, the 70% booked for 2026 number. Now let's turn to our segment that is explicitly not financial advice.
Here we go.
This is purely a thought experiment for sophisticated investors. The outrageous but plausible trade.
And the setup here is everything. You have a company that has de-risked its balance sheet, confirmed locked-in yield growth for 2 years, and just got a credit upgrade. And yet, before this report, the options market was really put heavy.
Aye.
A 4.9 to 1 put-call ratio.
A lot of bearish hedging.
A lot.
Yeah.
And that hedging pressure now looks totally mispriced, given the vote of confidence from these forward bookings.
So the question becomes, how do you make a levered bet on management just flawlessly executing on that AI-driven yield optimization over the next 90 days?
The trade thesis is pretty simple. The new floor for the stock is solid because of that B2 rating and the 1.6x leverage. And the pricing power should drive high single-digit margin expansion, which should lead to a pretty quick repricing upwards.
So what's the pitch? The actual trade?
You implement a bullish option spread. You're buying volatility, leveraging momentum. You'd buy the December $65 calls, betting on a rapid $5 move higher.
And how do you finance that aggressive call purchase?
By selling a put spread below the stock's new floor. You're essentially betting that the market now accepts the stability from the balance sheet. The goal is to maximize your upside exposure to that confirmed pricing power in the AI story, while taking advantage of that old put-heavy skew, betting the price floor holds firm around 61 or 62.
So it's an aggressive trade that wagers on momentum and flawless execution over the next quarter.
Exactly. Outrageous, but plausible.
A compelling way to play that confirmed revenue certainty. Okay, let's bring it all back home. Viking Holdings delivered a stellar Q3. They hit a record net yield, they radically de-risked the balance sheet down to 1.6 times leverage, and they gave us extraordinary forward visibility.
The key takeaway is simple. Viking is performing like a premium growth story should, demonstrating discipline, scale, and it validates their big market premium. And of course, a reminder that everything we've discussed here is for informational purposes only. It is not investment advice.
And we'll leave you with a provocative thought that builds right on that strengthened capital structure and that new $1 billion credit facility. Management keeps hinting at opportunistic inorganic growth. Things outside of cruises, like specialized land-based products, or maybe even a faster expansion into the huge Chinese market.
And with their capital structure so much healthier now, the critical question for the next year is this. Will Viking use that 1.6 times leverage and all that optionality to go out and make a major margin-accretive acquisition outside of their core cruise business?
Because if they do that, that kind of transaction would fundamentally transform the company.
It could unlock huge market value. It would be a pivot from being just a successful cruise line to becoming a broader Viking travel platform.
And that strategic pivot is the next evolution we'll be watching for in Viking Holdings. That's Deep Dive for today.
We'll catch you on the next one.